I was hoping to be like one of those like clips on TikTok you see of fake podcasts.
Yeah, right. That's the thing. You look like you're on a podcast when you have the headphones on.
Yeah, now it just looks like,
Instead of we just randomly got together to chat
and put these microphones in front of us.
Part of it is like
with Bloomberg podcasts behind us.
Yeah, right. I guess we've conveyed podcasts efficiently with all of the Bloomberg podcast
That's
signage.
true.
But I don't know.
Part of the reason this has to be on video is because Matt shaved. Matt has had a beard for the past several months.
I didn't know
that.
I've had a winter beard from like Christmas break through Memorial Day.
I shaved over COVID for the first time in about 30 years.
Okay.
And my kids freaked out.
Yeah.
They were like, "You're an alien."
Yeah. My kids didn't care that much, but one of my sons said, "It's a different daddy."
Well, you also have hair on the top of your head.
Yeah.
When you shave the beard and you don't have any hair, suddenly you're Mr. Clean. You just...
Does Mr. Clean not have a beard? I guess he doesn't.
No. I don't think so.
Mr. Clean.
It's the Money Stuff Podcast. We have a guest, Cliff Asness, who runs AQR. Thanks for coming in.
Thanks for having me.
I don't know what you want to talk about, but I always like to ask hedge fund managers, like, what do you do for a living? Like, what is like the economic function of like the business that you run?
Okay. Those are, to me, slightly different questions.
Right. One sounds like it's about you. One sounds like it's about AQR. I'm more interested in AQR. Let me just in you.
No, even if it's about AQR, what you do for a living is, and people might not like this phraseology, but you're trying to predict what happens to securities. You're trying to buy ones that go up either in the absolute or more than some benchmark, and sell ones that do the opposite. The broader question, which I think is behind what you're saying, is what do you do for the world by doing that?
Right.
And they overlap, but they're not exactly the same thing. Right. Something can have a net positive effect on the world, even if you're not waking up. And I'll admit this: I don't think most people in their jobs wake up and always think that way. And certainly not active managers just go, "I am just making the world a better place." They're thinking, is NVIDIA undervalued? Is it overvalued? The things that I think you do for the world is first take the other side of positions other people disagree with you on or don't want to bear. That can take two forms. That can mean one of you is biased and wrong. You hope it's not you. But in that case, what you do for the world is you move prices back towards, not necessarily all the way to, in the abstract, the correct price. That's hard to define, actually. But something is mispriced, and you take the other side of that. It could be a risk premium other people don't want to bear. In a lot of strategies, it's not necessarily that they're making an error. If mergers are announced and 3/4 of the pop you should get if it closes happens, a lot of people might not want to stick around for that last quarter. And if you're willing to take the other side of that, maybe you get paid a little for doing that. And that is a service to the market. People want to get out, and you're helping. That's the kind of the positive side. But again, it's not what you're thinking about when you do the trade. There are positions active managers will take that are not about that. Let me put it this way. If what you're trying to do is predict returns, you can predict returns because the price is moving towards truth, but you can also make money if you predict the price moves further away from truth. If you're a momentum meme stock investor, and doesn't mean you can't get that right. I think of that a little more as trading than investing, but they all come together. And it even gets complicated within some famous quantitative factors. One famous quant factor is the momentum factor.
Yeah, I was going to say, I asked a finance professor, what should I ask Cliff Asness? And he said, you should ask him if momentum trading makes markets more or less efficient.
We don't fully know, but I can tell you the framework. There are two competing explanations in academia and the general world that cares about these things for why momentum on average works. There's always a third, that it'll never work again and it was just random and it was just luck. But if it's true, why does it work? And I actually think these can both coexist, so it's not truly embarrassing, but it sounds embarrassing, that the two major explanations, one is underreaction and the other is overreaction. When you've narrowed it down to two things that at least feel like the opposites, you should feel a little shame for for a second.
Is the explanation just that like there's a correct price and momentum is trading from below to above the correct price?
Well, I'll give you two scenarios. Information comes out, and people have a behavioral bias that behavioral psychologists would call anchoring and adjustment. They move towards, but not all the way to, the newer information. And I think that fits a lot of intuition in the short run. That can make momentum work if you're following fundamentals or prices. Good news comes out, or the price moves. If good news comes out, on average, the price goes up, but not enough. If the price moves, it may, on average, be responding to good news, and simply by observing the price move, you can say, okay, sometimes it's wrong, but on average, it doesn't quite move enough. If that's the reason, and I think the weight of the opinion in academia, I believe, is towards this underreaction explanation, then even though you're trading on momentum, you're still moving the price towards kind of truth or equilibrium or something. But the flip side is overreaction. You think of that more as just your classic positive feedback loop. Someone's buying something just for, FOMO. It's been going up in there, and that could be a negative reason, or they're just predicting more people buy it because of FOMO. In that sense, if you buy, I don't want to pick on any particular thing. If you buy some weird meme coin, and you're doing that, are there non-weird meme coins? I don't know. But if you're doing that, you could do that for a rational reason, because not that you are a long-term holder, but you just believe it's going to keep going.
So wait, did you make money on GameStop?
This is the God's honest truth. You won't believe me. I have no idea if we were long or short GameStop during the whole thing.
You never went back and checked?
No, I never did. I did have an episode where I mentioned on perhaps a different TV network that we were short AMC.
What did your Twitter look like after that?
It was very ugly.
Yeah.
I certainly knew of that world. Even though we're quants, I watch the markets all day, even if I don't do anything about it. It's like the old joke about the weather. Everyone talks about it, but nobody does anything about it.
It's the best thing to talk about.
So it's not like everything that went on with GameStop, Melvin Capital. I'm watching it every day. But we take relatively tiny positions in every stock. There was nothing weird in our P&L. I was not even curious. It probably wasn't even in our universe at that point of things we trade. But then I'm going on this other network that
we know it's okay.
It's allowed.
Yeah, we'll bleep
I was
you.
going on CNBC.
Yeah.
And in kind of a pre-call of what are we going to talk about, you guys know you don't want to get on there and have absolutely nothing to talk about. You want to have some, not necessarily the answers worked out, but agreed upon topics. They're like, everyone in this segment gives us some longs and shorts. But I'm saying, as a quant, that's kind of silly. They're not indicative. And we kind of made a deal where they'd let me briefly explain that doesn't make a whole lot of sense for quantum, but it might be fun. My way of saying it was, if I give you a few names long and a few names short, you could look in 6 months later and think we had a fantastic year or a terrible year and be terribly wrong in either direction because they're tiny. So I went through, and AMC was, I think I'm accidentally doing it again.
We'll keep going.
Hopefully they don't listen to you guys.
Oh, well, we'll find out, won't we?
No, this is between us.
But it was bad on every single thing in our model practically, which is hard to do. It was expensive, unprofitable, high beta. They were issuing shares, not buying back shares. There are more examples. And so I said that, but then I added that we're only short 12 basis points. So the crazy people could be right, and it doesn't really matter. I discovered two things. They're not going to like a short period. And crazy people don't always like being called crazy.
Yeah.
I had to discover that for myself. So my Twitter got ugly for a while. You may have noticed. I've gotten, I think, a fair amount better at this, but I used to be pretty bad about responding to ugly, which you learn your lesson on that.
You always feed the trolls.
Less so than I used to.
Yeah.
At least I think I'm better. Maybe I'm wrong. But I became public enemy number 3 to the meme stock crowd for a while. I did not.
Really?
Yeah, 3.
Second to Ken Griffin.
Ken Griffin was number 1. I don't believe Ken did this, but it's the whole pull the buy button
whole
thing.
Story, yeah.
And oddly enough, Gary Gensler was clearly number 2.
Oh yeah.
Because they thought he was covering for the manipulators and the naked shorts and whatnot. I've met both. I know Ken a little better than Gary. I don't think there are any two people on earth less likely to be in cahoots than those two. I think they're on the opposite side of most issues, but that was the theory. But both Ken and Gary are too smart to respond to them on Twitter. So I certainly became the most actively engaged, and then I never did that again.
Yeah.
Before today, when I've accidentally done it.
Before we get back to stuff that matters, can I just say on AMC, I tweeted, when did Dune 2 come out? I don't know. It was like last summer, I believe.
Yeah, a year ago.
I tweeted that I fell asleep during Dune 2, and it reawakened that crowd, at least on my Twitter, because
The same crowd or just
the
like...
AMC crowd.
Because
she's
she's
movie
dissing
theater.
a movie.
Yeah, I
see,
failed
I
to
see.
appreciate.
Don't you understand? You have to like every movie,
Yeah.
or else you're anti-America.
And then there were a lot of conspiracy theories about Bloomberg reporter lies about falling asleep in Dune 2
wow.
because
That
she
would be
hates
securities
AMC.
fraud.
It
Yeah,
would
wow.
be, but it wasn't. It
So
was
you
just,
got a little of this too.
Oh yeah,
Yeah, you do innocuous. I was obnoxious, so I kind of deserved it. You didn't deserve.
Thank you for saying that.
You didn't deserve it.
I haven't seen Dune 2. I saw Dune 1. It was good.
I saw it too. It's pretty good.
No, you didn't actually.
I didn't.
You were asleep.
Well, no.
Not the whole time.
Not the whole time. Anyway, how do we transition?
Wait.
We were talking about momentum
We're
being
talking about...
We
yeah.
certainly
inefficient
were.
or efficient.
But also, like, you went on CNBC, and they were like, give
We're
me some
gonna
longs
bleep
and
that
shorts.
too.
And you gave them some longs and shorts. Would you have known that? Or did you have to be like, I gotta
I
go
would
look
not
at the
have known
portfolio?
that.
Right. So you don't, like, you don't know what you're long or short.
It would have been better for me if we didn't have the call, because then I could have just said, I honestly don't. I don't know.
Right.
I rarely know individual stocks. And if I do know, I'm probably not happy I know.
Huh. Well,
And even then, it's like we lost 20 bips on that today, which is a giant number for us to lose on one stock. And even then, I probably don't notice.
yeah.
Okay.
I will
So you
say,
lose 20 bibs, someone comes to you and says, that stock went down. But
I might be told about it. For us, it's whether these 750 stocks beat these 750 stocks. And
Yeah.
I don't memorize 1,500 stocks. Now, we take a fair amount of risk. Some funds more, some funds designed to be less. And that's about the size of these two positions. So I don't, when I say small, I'm not saying we're not both taking risk and trying to generate pretty decent returns. But if you just think about it, a quant is playing the odds. They're saying a firm, a company with these characteristics, and this can be old school factor quants from the 1990s. These can be modern machine learning, but with these characteristics tend to beat these characteristics. If that's all you know, and it is all we know, why on earth would you take a lot of risk in any one company? AMC really could have done well. It could have been bad on every single thing that on average doesn't work, and it could be a special situation that we don't understand. Something could be good on everything, and the CEO can embezzle all the money. We don't want to take a lot of risk on any one thing. It's because we have no insight in that. It's risk for no return.
one thing you've written is that, like, over time, the quant, like, factor model has moved closer to being what Graham and Dodd investors do. Like, are you like an abstract, like, meta Graham and Dodd investor? Is that like the way to think of what you do?
I think it's moved closer. There are still differences, and maybe some of the, like momentum, if it's overreaction, if you're riding momentum. I don't think a Graham and Dodd manager does that. So I don't want to push the analogy, but this came out very, very early in my career. This is like 30 years ago. This is like my Goldman Sachs days. I started hearing a lot of active stock pickers. Some I'm still friends with one guy in particular. But they all, I was laughing at them, and I was telling my friend, you all say the same thing. You all say you're looking for valuation plus a catalyst. That's like I don't know if everyone says it, but I've heard it many times. And I'm making fun of him, and at some point he looks at me and goes, you do value and momentum. And it was a gotcha. He won that round because I'm like, okay, I see your point.
Right.
So even back then, you can think of those two together. We literally add them up. We're not, but if you think of them as this holistic system, we're looking for cheap things that are starting to get better in price or fundamentals over time. And now I'm not talking the really modern stuff, alternative data, machine learning. I'm talking just classic quant stuff that's in academia and then ports over to applied. Profitability is a factor. Robert Novi Marx wrote a great paper that we all incorporated, where all else equal, given valuation and momentum, if a company is more profitable on some famous scales, gross profitability, ROA, ROE, that's some degree of positive. Low beta. investing. Two of my colleagues, Andrea Frazzini and Lasse Peterson, resurrecting stuff Fisher Black did, and they're very good about saying Fisher did it first, that lower beta stocks, if you're famously a capital asset pricing model person, they're supposed to, on average, underperform higher beta stocks. That's the main output of that model. It doesn't work. Mm-hmm. I mean, it's one of the largest empirical failures ever. It doesn't work in any kind, even outside of stocks. People test it in other places. Therefore, it kind of makes low beta stocks a little bit of a free lunch because they are lower risk and they keep up. If you actually go read Graham and Dodd, they're not just buying low multiples. They're much more holistic than that. High quality companies that have a moat, that have some kind of margin of safety, I think was the term they use. Margin of safety and looking for low risk doesn't sound so different. Mm-hmm. So over time, I've thought at least a core amount of what quants and academics, if you take them as a whole, are finding is the full panoply of stuff that a Graham and Dodd investor. We do it very differently. Again, we're betting on the concept working on average. They are using it in a soft or a hard sense as a screen to look for candidates, and then they're trying to learn a lot about that situation. Their upside is if they learn a lot about that situation, they could be more reliable than my, hey, we could be wrong about AMC. And their downside is they better be right. The concept can work, and they can still lose if they're wrong about the specifics. So over time, I've gotten a little less hubris about this. I think quants caused the problem, by the way. I think when Gene Fama and Ken French started looking at like price to book in the late 80s and early 90s, and there were other people who did it too. I'm just a Chicago guy, so I'm going to just go with Fama and French.
Fair enough.
They did it best, in my very biased opinion. I don't think, I'd have to go back and check, but I don't think the first few papers used the word value investing. Over time, low multiple investing in the quant world came to be called value investing. And in the Graham and Dodd world, they'd get kind of mad at that. And they'd be like, it's not value investing. There are plenty of low multiple companies that deserve to be low multiple, and there are plenty of high multiple companies that deserve it. And I think over time, the quantitative process agreed with them more and more. So I still think it's a communication problem because they'll still talk about the value factor.
Yeah.
And that's in the quant world, that's just low multiples. Mm-hmm. And if a Graham and Dodd manager gets mad, or any old school active stock picker gets mad at that, I'll just say you're right, because value implies a more holistic thing.
But isn't like modern quant and what you're doing now kind of that more holistic thing? Like you're just ingesting more data points and you have a less linear model, and it's like moving towards that anyway.
If you look at machine learning, where either to construct factors. One of the best uses of ML we found is a subset of ML called natural language processing, where you take textual data and you try to say, is this good news or bad news? Quants have kind of done this forever. You get transcript of an earnings call, and the old school way to do this for a long time was you count up good words and bad words, good phrases and bad phrases. So increasing, +1. And you parse the whole thing, and I'm sure you guys immediately see the problem. If the actual sentence was massive embezzlement is increasing, then you were off on that +1. Quantitative stuff can survive doing some horrifically stupid things in isolation. If 53% of the time increasing is a good word, then 47% of the time you were stupid. Turns out natural language processing, or NLP if we want to sound like the cool kids, that is taking that same data and training a ML model to say what predicts and what doesn't predict. It, of course, never gets near perfect. Mm-hmm. At the end of the day, though, we believe it does a lot better than the word count methods and is additive to a model. But importantly, and I think this was your point, Matt, it's not qualitatively different. We've looked at both price and fundamental momentum forever. Fundamental momentum, the classic measures of things like our earnings being revised, and you want the revision, you want the new news, up, faster or slower. Our earnings surprises coming in positive or negative. And this is this anchoring and adjustment idea. If that's good or bad news, you can make money trading on it because it's not fully incorporated in the stock price. Parsing an earnings call poorly as in the past or better now, we think of it as just another form of, are good things happening in the near term? And if so, they're probably underappreciated. So yes, I don't think it's changed dramatically. It's much more of an evolution rather than a spirit change. But we got bigger tools in the tool chest now.
But it is moving. I mean, like, you know, you asked like what a sort of like traditional old school fundamental manager would do. One thing they'd do is listen to the earnings call and like talk to management, right? So it's like your machines are moving in the direction of being an old school analyst.
Yeah, as someone with 4 kids in or around college age, my wife and I, and she's done a lot more of this, have spent a lot of time trying to figure out what careers will not be utterly destroyed by ML. And it's not an easy question.
Podcaster.
No.
Yeah. Podcaster.
I don't know.
A podcaster is probably a good one for a while. They have those fake
It's a
ones.
terrible answer.
So we'll all be podcasters. But yeah, it's another example. I always say these useless statements like on a sufficiently long horizon, we're all replaced by machine learning. It's a question of
I look forward to that day.
We're getting way too philosophical, but the transition to that can be very painful and weird.
Yeah.
But a world of abundance and leisure may be our horrible fate in the long term.
You know?
I'll take it.
Yeah.
I want to talk about market timing because
Sure.
I was reading the Virtue of Complexity paper from Brian Kelly et al.
I will say he may be one of the only hosts of a podcast to read that paper. This is not a simple paper, though he writes very clearly.
It's the sort of like, it's the notion of taking like a sort of simple factor model and blowing it up into like a nonlinear AI model. And one like almost throwaway sentence in the piece is like this like simplified AI model that he built for like illustrative purposes lowered its risk before 14 of the last 15 recessions. And I've always thought like the naive like best way to invest would be just market timing, just like, you know, have all your money in the stock market before the market goes up and not before it goes down.
If you can do it.
And my impression is that like respectable hedge fund managers, respectable quant managers, respectable academics say the hardest thing in the world is market timing. And no one claims to get alpha from it, and it's not a thing. Is that changed? And is that changed due to like machine learning?
It has changed a bit.
Are you
I
market
don't
timing
think
now?
we do trend following on macro assets. Old school CTA stuff, we think we've made it new school by incorporating fundamental momentum, by doing a lot of more esoteric markets. So we think even that's had a march of progress to it. But all else equal, I wrote my dissertation on momentum in individual stocks.
Right.
For some reason that I cannot explain, if you're using past returns to predict the future, just what's going up will keep going up and vice versa, to pick individual stocks, the whole industry calls it momentum. And if you think markets tend to keep going the same direction, everyone calls it trend following. Same thing. Starting in, I think, 2008, we always had it in our macro models, but we started formally offering separate trend following products. And that, it doesn't take hero bets on any one market. It's not, Gazzarelli selling all the stocks a minute before October 19th of 87. I'm dating myself. My wife's birthday is October 19th, which always gets a little amusement.
No kidding.
Crash 87.
Meant to be.
Did you give her like crash themed gifts?
There have been some jokes over time. So trend following it's essentially market timing, but it's highly diverse. Many small bets. Whatever's been happening tends to keep happening. That's the main way we'll do market timing.
You won't do like your main equity fund is like sometimes net long.
That was kind of a toy model to illustrate a point. I know we're not taking a lot of risk on that model. Market timing, I still think is quite hard. Might there be advances in it in the future? Absolutely. But are we taking significant risk in it now? Aside from trend following, not really.
I want to ask you, like, you probably submit more papers to financial journals than the average asset manager.
By like 100%.
Like, I want to ask 2 questions. One is like, I want to learn about your relationship with academia, because I think it is fascinating that like you employ half of the Yale faculty and it's like the finance PhD pipeline runs mainly to AQR. But then 2, because like I think of like what a hedge fund manager does as sort of like finding anomalies, finding like market inefficiencies, finding factors that are predictive of returns. And I think of what a finance academic does is mainly also that. Like, when do you publish and when do you just trade on it?
Oh, there's so much to talk about here. First, there are a lot of reasons we do it. One is just personal consumption. We grew up in this world. We like being part of it. We were interested in this stuff in a purely academic sense before we got seduced into making money.
Right. I mean, I would like posit that you think there is a value to employing fancy finance PhDs to like build your models, and the way to attract fancy finance PhDs is to offer them the most academia-like possible work environment, which includes publishing papers.
And to letting them publish. There are people, including our two Yale professors, I don't know if would have come to AQR if we said you can never write about this. We do a crass calculation, though. Right. If we think there is something that we are relatively unique on, entirely unique, or a very small handful of people know this, we won't publish it. The optimal
but that would get you tenure.
The optimal time to publish a paper is after you've made money from something for 11 years and an hour and a half before someone else is going to publish the paper. Mm-hmm. And we cannot get that right. I can think of one example of momentum and factors, the fact that factors themselves, like value, profitability, also exhibit momentum. As something that we've traded on for many years, that we've always refrained from writing a paper on because no one else had. And again, we knew we couldn't be the only people who do this, but we didn't think the cat was out of the bag. And then someone else wrote the paper. And I'm sure we've done this to other people too, because you never know what they're doing internally. So life, you do it long enough, life works out kind of fair. But that is the goal.
But you were mad there because, like, as academics, you wanted credit for that paper and
fun.
Someone else published it?
It's just, it could call it childish, but it's human. It's fun to discover something.
Were you also mad because publishing that reduces the value of the signal? Or?
Maybe a little bit. Maybe a little bit. So far, it still worked wonderfully. The trend is still your friend when it comes to factors. But it would be a fireable offense from AQR to publish something that we thought was truly proprietary. Let me give you my favorite example of this, because it came up recently. One of the things that we've gotten into in a fairly big way, as have some other quants, is what's called alternative data. Those are new data sets that people put together with sweat equity. The classic example, and the only one, and this is the point that I'm allowed to talk about, are credit card receivable data. Where are credit cards? Because that's been discussed a million times.
That's like barely alternative.
Then. Yeah. Well, that's the point. This stuff is arbitrageable. I mean, it can go away. Value, be it the narrow quant sense of value or the more broad Graham and Dodd sense of value, is trying to take advantage of, I think, basic human nature. I think spreads between cheap and expensive are wider still than the historical average, not tighter. I don't think there's a lot of evidence that so much capital is in that it's making it go away. If you get a short-term information advantage because you have put the time in or paid someone who's put the time in to create a new data set that other people don't have, they're going to have it eventually. Mm-hmm. So I am talking to the Australian Financial Review. I don't even know if we had discussed alternative data beforehand, but he asked me about it. And I said to him that our head of stock selection, a fellow named Andrea Frazzini, I might have said told me, but has asked me not to talk about these things. There are things I'll talk about, but there are things we think are, overused word, but are true alpha that the world doesn't know. And I think it's reasonable, so I really can't talk about them. He writes the article, and what it says is mostly that, but instead of saying he's asked me not to talk about it, it says Andrea Frazzini won't tell me what we're doing in alternative data, which it has a slightly different connotation. It has the connotation of addled old man, don't worry about it, we're doing some stuff here. So again, it's an example where there certainly are things we won't talk about.
Yeah. Is that ever true? Like, are your most cutting edge machine learning people like, don't worry about it? Or do you read all the papers?
I read most of the papers. Okay. I don't read all of the papers. I at least skim all the papers. I know the gist. We do a lot of different things at this point. Once you're a quant, you want more factors and you want to trade it in more places. Mm-hmm. And I will admit that a week doesn't go by where I don't ask someone for a review of what we're doing somewhere. Mm-hmm. At some point, I approved it. Mm. So Passcliffe had some understanding.
Yeah.
But also, just some of this is pretty decent math, and the old mathematicians do their best work in their 20s. I can tell you, I'm probably still decent at math, but I'm not what I was when I was 20, when I was 22. I think wisdom has hopefully replaced some of mathematical ability.
Like, is the personnel at AQR different from at I don't know who you think of as quantity competitors, but my impression is that you have many more finance PhDs than other places that might have more like
Pure math people.
pure math undergrads or something. Like,
Yeah, I think there's some truth to that.
like what makes them better or worse? You know, like
First, I think there's going to be a correlation that the closer you get to the high frequency world, the more you're going to be more in the pure math realm. My very tortured analogy is quantum mechanics versus Newtonian physics. Right. When you get into the high frequency world, first you have a ton of data. By nature, you just have a lot more instances, and a lot less theory. Mm-hmm. So turning yourself over to the data, more so than having an economic rationale, is far more rational, and that becomes a more mathematical exercise. We tend to think like in our long 700, short 700 stock portfolios, average holding period is maybe 9 months, maybe closer to a year at times. That's nowhere near high frequency.
Yeah.
High frequency, when I wrote my dissertation, and I did have this in there, was a monthly contrarian strategy. Now we're talking, sub-seconds kind of thing. I think when you're going to have a medium holding period strategy, as I think of us, we're not Warren Buffett, but we're not HFT. Even the machine learning stuff needs some economics, too. You simply don't have enough data, and there's too much of a dimensionality. Even with Brian's virtue of complexity, you need to give it some structure, or else it's going to overfit and go mad. So I think that's the reason. I'm not saying we'll never do something in a higher frequency world, in which case we'd probably have to shift more.
Right.
But in our world, being a mathematician, being an excellent programmer, but also having the economics behind it, is kind of what we're looking for.
right. I think of like Renaissance as famously employing exclusively people who have never thought about markets or finance or economics, and like they come to it pure. And I feel like you are very much like people who have math chops, but like have economic intuition and think about it as an economic.
I think that's
model.
accurate. I do have a couple of Renaissance observations.
Okay.
One of my favorite questions people ask me is, you have to know, how'd they do it? And I love that question because I get to respond. So your hypothesis is, I know how they took a few $1 billion and still take a few $1 billion out of the market to share among a relatively tiny group of people every year with apparently very low risk, and I choose not to.
Yeah.
I have some inklings of the general, what they've worked on. My biggest guess is that they were 10, 15 years ahead of everyone else on most of this stuff, and have developed more sophisticated systems over time. I think natural language processing, they were very early on.
Mm-hmm.
But they all came from like Mercer,
IBM and stuff. A few other things. John Liu and I, one of my founding partners, wrote, when Fama and Schiller shared the Nobel Prize, we wrote a whole overview of market efficiency and the debate about it. And I brought them up as an example. The Medallion Fund has almost nothing to say about market efficiency. It says these guys can extract a toll on the market with reliable consistency, but in terms of market size, it's a giant number for a few people to make each year.
Yeah.
It's a tiny number in terms of whether the markets are efficient. And apparently the rest of us can't do it quite as well as them. They're the GOAT when it comes to this.
Yeah. I think of like Jane Street can reliably extract some money from the market. And I think of that as not like, I think of that as like a fee for service.
Yeah,
almost. Like they're like a market maker, right? Rather than being like a predictor of asset prices.
I'm going to guess, and again, it's a purely guess, that not all of it, but a fair amount of Renaissance had a similar flavor.
I think when you talk to people who run pod shops, like some of what they do, they think they conceive of as, it's not literally market making, but it has that sort of flavor of like.
And the constraint on those things is typically capacity.
Right.
Now, it's a ton of money for those firms. They're amazing firms. But I'll give you an example of Renaissance. I've complimented them like crazy, so hopefully they won't be mad at me for this one last comment. Everyone talks about the Medallion Fund, but no one's allowed to invest in that. They keep that for themselves. Another favorite question I get is, this doesn't happen much anymore, but every once in a while I would get an investor saying, is the Medallion Fund better than you guys? And I'd be like, oh, hell yes. But they won't take your money or my money.
Yeah.
And I think we're pretty darn good, and we will. So why is that relevant? But Renaissance also runs a fair amount of money in more open institutional products where they look very good. I'm not gonna deride them at all, but they don't look better than us. They look like really good, solid, regular quants. So What they cannot do, I think it's kind of obvious, is take the medallion process and scale it up many, many times bigger. They've discovered a way, as you put it, to just take a certain amount out to provide a service. I called it taking a toll, and that's amazing. But they've not discovered a way to do that at institutional scale, which thank God, because that leaves something for the rest of us to do.
I want to get back to something we talked about at the very beginning, because you mentioned that paper you wrote with John Liu, which you talk about like the two possible explanations for making money, for anomalies, for whatever, which are sort of behavioral, like irrationality or whatever, and you're bearing a risk for for someone. Everything you write and like what you said here, you seem sort of like agnostic about which one or what combination there is. Like, do you prefer one? Like, is it more reliable to get paid for taking a risk, or?
Well, forgetting which one you think is really going on, they do have different characteristics. The positive behind a risk premium is you may be able to get it forever,
right?
Because it's rational,
right?
That you get it. The negative behind it is it's a risk premium. You have to figure out why. If the risk premium is most of the time this is fine, but it has depression risk. It's going to do particularly bad in a depression. Mm-hmm. Well, that's not a very pleasant risk to have. You may get paid for doing that. The positive of behavioral is it's essentially over the long term. Over the short term, it can be a very, very painful lunch because it doesn't always work.
Right.
But if on average it works long term, it's a free lunch in that you're not taking additional systematic risk. The negative is it can go away. It can be arbitraged away. If that error stops being made, if too much capital chases it, it can be arbitraged away. It's hard to arbitrage some of them away, like basic valuation. It's very easy to arbitrage some others, like alternative data, where the point is to be quicker to getting a data set and to trading the data set. I will say this, and I hope Gene Fama isn't listening. I was probably 75-25 a risk guy 30 years ago. I'm probably 75-25 a behavioral.
Is that GameStop or something?
No. Well, GameStop may be the unfairly extreme example. It's not fair to pick the most extreme crazinesses to make your point, but it's real life experience. It's watching the spread between cheap and expensive stocks in 99, 2000. Mm-hmm. We started our firm in late 98, so right before the real crazy part of what's called now the dot-com bubble. The spread between how we define cheap and expensive, either just using quant multiples or adjusting for forms of growth, was set records. We had 50, 75 years of data, and we lived through it blowing past those. Then after that, I'm like, all right, that was a once in 50-year event. We survived it. We ended up being right. We ended up making money round trip. That was excruciating on the first leg. If you asked me back then, am I ever going to see that in my career again? Mm-hmm. I hope I'd be smart enough not to say never. Mm-hmm. None of us in our field, yours or mine, should say never. Markets are pretty hard things to say never about. But I think I would have said it's highly unlikely. For one, it was literally the most extreme event in at least 50 years. Second, the question presupposes I and people like me will still be around. And presumably, if we're still around, we're in more supervisory and authoritative positions. So how's it going to happen again? And then it happened again, almost exactly 20 years later, from 2018 through 2020. You can point to COVID. It went absolutely mad during COVID. You guys remember for the 6-month period after COVID when the only two stocks you're supposed to own were Peloton and Tesla. One of them has still worked out mostly for you. One of them did not. But even before COVID, though, you cannot pin it on COVID. By late 19, early 20, we were approaching tech bubble levels, which, again, had not been seen in the prior 50 years before the tech bubble. Again, painful period for us. Again, made money round trip. I'm going to brag about that. We survived it. I think we're stronger than we were beforehand. But if the first one didn't make you start to go, this behavioral stuff may be real and maybe bigger than it used to be.
Yeah.
And I wrote a piece called The Less Efficient Market Hypothesis about markets getting less efficient. That may be true, but I think it's more accurate to say what my evidence is, they're prone to some extreme bouts of craziness on occasion. It's not quite the same as in steady state always being less efficient, but it's probably some of both. But I do think that has happened. I probably was not giving behavioral enough credit early on, and I think it's gotten to be a bigger part.
I want to read something from the John Liu paper from 2014. Suppose you imagine some investors get joy from owning particular stocks. For example, being able to brag at a cocktail party about the growth stocks that they own that have done well. One way to describe this, some investors have a taste for growth stocks beyond simply their effect on their portfolios. It can be rational for them to accept somewhat lower returns for this pleasure. But even if rational to the individuals who have this taste, if some investors are willing to give up returns to others because they care about cocktail party bragging, can we really call that a rational market and feel this statement is useful? I feel like that was like a little prescient about how I have experienced some of the last 5 years, which is that like it seems to me that it is hard to explain some of the stuff I write about, which is maybe not like the most important thing in the world. It's often like
I think
weird
it's the
meme
most
stuff.
important thing in the world.
I do too, but like it's like, it's maybe not like the biggest, dollar value, although Tesla's pretty big. It does seem like a thing that is regularly happening is that people have a taste for stocks beyond any rational or irrational calculation about how it will affect their portfolios.
Well, particularly the whole meme world,
Right.
meme coins are clearly a political statement
Yeah.
slash.
I mean, clearly there is a non-economic motivation for some of that, and you can call it rational, but it's odd.
Well, a few things. That paragraph, even writing it, I think we went a little too far because I don't think these people, we kind of write it like they're consciously doing it. Like, I just love owning these. I know I'm going to lose money. I think they kind of end up,
I don't think that
they resolve cognitive dissonance by saying I'm going to make money, even if that's what's really going on.
right. I think this was maybe a little harsh on growth investors in 2014, but on meme investors in
No,
2025,
it's
I don't
dead
know.
on meme investors. We were also given a little mild shot to some academics who kind of try to save market efficiency by saying it's more meta efficient if you count people just have tastes for this. That argument's been made, and I think that's kind of a cop-out. If we dumb market efficiency down to that, what do we actually even mean by market efficiency? If you go, I know I'm going to do terrible on this, but it's fun. To me, that's functionally a fairly inefficient market. So we proposed in that piece, which did not catch on, that classically market efficiency and the testing of it has a joint hypothesis problem. You're testing whether markets are efficient, but you also need a model for how prices are set. Mm-hmm. And if that model for how prices are set includes this is fun to own, then you've pushed it too far. It has to be a reasonable hypothesis.
See, this is what I read about. I want someone, and it's probably not me, to write a finance textbook that incorporates the factor of this is fun to own and gives some guidance on how to price that.
Yeah.
Because
and how to
it
predict
seems
what's
real.
going to be fun to own and how long it's going to continue.
And people, like, someone is making money on this.
Oh, yeah.
And, like, not just, like, fading it. Someone is like, I have a model for which meme coins will go up. And
Well, people have
making money.
tried to do that. You think about all the different buzzy strategies. I'm thinking about ETFs that
Sure,
would
but,
just
like, but real people
scrape.
who can do it.
Yeah, but there have been attempts if you scrape social media, et cetera, and find out what people are buzzing about. But
Yeah, it's the old value manager's lament, but it's also, I think, true. If ultimately it's a bad investment in return sense, that will happen eventually. I do think that time horizon and the extremes have lengthened. A lot of the point of this.
Why will it happen eventually?
Why will it happen eventually? If you buy a company that continues to perform poorly and you paid a ton for it, I think there's only so long that can go on. I think it gets more and more obvious, for one thing.
I think a lesson of the meme stock and frankly of crypto is that fundamentals set a floor on valuation because
But not
like
a
you
ceiling.
can always like do an LBO, right? But then they like I don't want to just be mean to Bitcoin for no reason, but like you could certainly have a model in which you say the fundamentals of Bitcoin are nothing, and like you could then say, and in 50 years it'll go to zero, but like that's a weird thing to say now. I don't know.
Well, let me be clear. I wouldn't short Bitcoin with my worst enemy's portfolio.
Right.
And I 100% sure I'll never say money is a little bit of magic. What becomes money is a little bit of magic. But I think the most of the probability is eventually zero, but it may be a very long time horizon. I think what we've learned watching this stuff is that time horizon is lengthened.
Okay. Time horizon is lengthened, I'll take. But
In my piece on this, I try to hypothesize And I admit it's real opinionated hypothesizing. You cannot prove, if I'm right, that markets are somewhat less efficient. Why? It gets even harder. But one of my favorite explanations is an old man complaining about social media and 24/7 gamified trading. I don't think most people need a lot of convincing that this stuff has made, say, our politics worse. Made us more in bubbles, hate each other more when it was supposed to make us love each other more. Markets are just voting mechanisms. I don't think it's any different than politics. So this notion that things get crazier and can go on for longer, and I have a very cynical view of your statement that this stuff might take 50 years. I think the more absolutely unsubstantiated by anything something is, the longer the craziness can go on.
Right. I think that, like, if you compare the longevity of Bitcoin to, like, the GameStop premium,
Yeah.
I think, right.
But go back to the tech bubble. Cisco Systems, great company, but was selling at a very stupid price, selling at about 100 PE when the E was gigantic. You can have a small startup company that's growing super rapidly, sell at 100 PE. One of the largest companies in the world with some of the largest earnings in the world selling at 100 PE. You needed some very heroic, and I would argue I'll never say impossible, but near impossible assumptions. Even if the tech bubble didn't break in March of 2000 when it did. And by the way, I still don't know why it broke in March of 2000 and not a year earlier or a year later. Once you're well past what I would consider rational, saying you know exactly where. But the time horizon you can imagine that going on for, when the growth is good, maybe even great, but not nearly enough to justify that price, it gets more and more obvious. If something is based completely on air, one of the weirder down Matt's point that there's no arb to the upside, as there's no LBO mechanism, and shorting it is just frankly too dangerous. It's a weird way to say. Sometimes people say markets are efficient because you can't make money from these things, and I'm like, it's another weird way to defend efficient markets to go. They can be so friggin' stupid that they're terrifying to make efficient. That may be totally true. But it also is a weird way to argue that markets are efficient.
What does it mean for AQR if markets are less efficient?
Well, any active management is an inherently arrogant act. You cannot tell the average person we should all be active managers. We should all have podcasts. But
I agree.
So it's an arrogant act.
No.
It's
we'll rise to the top. We'll outperform.
To believe you should be an active manager and to believe you're doing something good for your clients, you have to believe two things. That you have alpha and that you're not charging the full extent of that alpha through your fees. And we do believe that, and a lot of active management managers believe it. But it's an inherently arrogant act. It is consistent to say most people shouldn't do this, but we should, though the arrogance is obvious.
What percent of your alpha should you charge in your fees?
That is a super hard question. I've thought about writing about this at one point. It kind of depends on how unique your alpha is.
Okay, because I would think that if you got a pod shop manager really drunk, they would say 110%.
No, that's what they can charge for their fees, not what they should charge. I don't think they'd ever admit, no matter how drunk.
Right. They wouldn't admit it. But
It's like will versus shall.
Deep in their soul, like they want 110%, right?
It's a great question, but it's a hard question. If your alpha is doing Fromm and French price to book, by the way, I still think Fromm and French are going to be right in the next 30 years. They haven't been right in a while, but spreads have gotten wider and wider, and that's been a wind in their face. I wrote a piece on this saying the long run is lying to you, saying that X, the spread widening values, the simple Fromm and French value has delivered alpha. It's just lost on the repricing. But what you can actually charge for doing price to book should be very low, a very small fraction of the expected return.
Right. I mean, there are those who would say that's not who would characterize that as a beta, right?
But that's kind of what we're saying. Everything exists on a spectrum from one to the other. If you have discovered and built the database yourself, an alternative data source that you have built, this is extreme, and I can't think of an example at AQR that fits this, but you can charge nearly 100% of that alpha because what they're getting is still absolutely unrelated to everything else what they're doing. There's some de minimis notion that if you charge 99%, maybe no one would bother to do it. But you can charge a large fraction of the alpha because what you're delivering is still ultimately net returns that you cannot get elsewhere that aren't correlated to the rest of the portfolio are worth it.
How should I think about how people set because we can talk abstractly about what percentage of your alpha you should charge, but like no one gets paid, no one gets sent a bill for like 90% of the alpha, right? Like, is pricing sort of like set by just like, anchored norms, or is it set by like?
Anchored norms is another way of saying what do other people charge who are in the ballpark of what you're doing. So of course that matters, right? If you are way off the anchor, way off on the high side, no one should invest with you. If you're way off on the low side,
there are people who charge really high fees and are like pretty good at demonstrating they have alpha. Then
some of the pot
fees.
shops charge insane fees and have been very good.
Right.
And that goes to that, are they doing something unique? And I think clearly, to some extent, they are. I think their problem becomes kind of in the direction of Medallion without going all the way. I don't think they've rebuilt Medallion. Nothing is that. But they should charge a higher percent if they're doing something very unique. And they do. I have a very, violin playing, I think, rosy view of how we think about fees. We're building a long-term business. We think we have business value. We do not think we're just a hedge fund. We run a lot of traditional assets too. Even the hedge funds, we were a big pioneer in doing the more obvious strategies at considerably lower fees, starting in merger arb and trend following. The way we broke into some of those as standalone products, not as part of our multi-strats, was charging less and saying, this is real and it's good, but you can do one of every merger,
Right.
which and make a fair amount of money, but that's not magic, and we shouldn't charge magic fees for it. But in that kind of kumbaya, big picture sense, charging fees such that clients are happy with the long-term results is probably how you build business value. Though not everyone does, clearly.
If you step back from just AQR, though, I'm curious to hear your thoughts on your industry overall and whether alternative strategies in general are too expensive.
Yes, they are.
Well, I have some numbers to back up that statement. There's this study, a new study out there. My understanding of it is that you basically take a 60-40 since 2008. You add alts exposure to it in various proportions, and that blended portfolio basically trails that benchmark, basically in close proportion to the fees that are charged by some of the alts managers. And I don't know, I read that and I was just kind of wondering, I mean, you could make the case that why are we charging so much?
Well, this is almost a mathematical certainty.
Yeah.
Forget about alts for a second. You cannot tell me the average active portfolio beats the market after fees and costs. Mm-hmm. It's the average active adds up to the market because for every deviation one way, there's a deviation the other way. When I said it's inherently an arrogant act to be an active manager, it means you think you got it, even though if you buy one of each, you can't have it. And I don't think alts, a subset of the market like alts could, but I think a lot of that still applies. It's an inherently arrogant act to say, but we've been saying this for at least 24 years. We wrote a paper, and yes, I start a lot of sentences with we wrote a paper, in 2001 called Do Hedge Funds Hedge, where we took the known indices of hedge funds and we tried to take out just the market beta. You could argue for a more sophisticated risk model, and that could, as usual, go down that rabbit hole. But we found their betas were, first of all, this is more mundane, but statistically underestimated, partly because a lot of hedge funds do some stuff that does not have perfect liquidity. And this was a small early version of what I got into at the private world later on. Mm-hmm. But if something doesn't trade all the time and you try to estimate its correlation with the market, you will underestimate it. Because one great way to look uncorrelated is to have a 3-day lag, and when you trade, your returns will be off. So the betas were underestimated by earlier studies. Given the correct betas, there was pretty much no alpha to the hedge fund world. I was, first of all, I was a lot younger then and a lot less well-known, so I cared. Nowadays, I quite obviously court controversy. But back then, I probably had 10 famous managers call me and yell at me about that paper. And the first time I was, of course, obnoxious. They called and said, "Why did you write this?" And I gave the obnoxious answer because we think it's true. And that was apparently not an acceptable answer. I will only call out one person on the positive side. Richard Perry, famous hedge fund manager. He called me up, and I already been yelled at by a whole bunch of people. And so when I heard Richard Perry on the phone, people like Richard Perry didn't call people like me back then. He was big, I was small, so I'm like, I know what this is. He's just going to yell at me. He gets me on the phone. He goes, "That paper you wrote." He goes, That's just correct. Good job."
All right.
And I'm only telling I'm not giving the names, and I do remember them, of course, of some of the.
You have their
meaner
names
ones,
written in a book
but
somewhere.
It's all right. I have a list of vendettas
All right,
in my brain.
that.
So wait, so you've been making fun of private equity managers on similar lines recently. Do you get calls from them?
No, they're so fat and happy. They don't even care about me making fun. No, I get yelled at by some, usually friends. I live in Greenwich, Connecticut.
Sure.
So
You all hang out.
Well, the country club, they're like,
I am actually not a
blowing up
member
our
of a country
liquidity
club. But the old, often used in a very bad way, some of my best friends are, so I'm off the hook. I have some good friends who are private equity managers. Most of them can accept you're right about the industry, but not our firm, which is essentially what I'm saying. So I can't, I'm not being mean about this.
Right.
You're not, like your criticism is volatility lender, right? Your criticism is that private equity seems to have a higher Sharpe because it has a lower volatility because it doesn't report.
Yes, that is my
Reports on a
main
lag.
criticism, which I think is quite obviously true,
Right.
but that's just me. Some people do disagree.
Oh, how?
The best disagreement I've heard, and I have some sympathy for this because I do not think markets are perfect, is we are right about the valuations. You are right that we move at a highly damped version of the market, but market moves too much. We are right.
Right.
My response to that is, why don't we get to do that?
Right, yeah, that's fair.
When we've had a tough year because the market's gone crazy and we were on the wrong side of that, I have to tell my clients we're down 12%. I don't get to tell my clients we're up based on where I'd mark the portfolio. So why one group? And by the way, they could market just like we market. They're brilliant at valuing companies, and they can tell you where they could sell it for today. So it's like an institutional legal quirk that they get to do it one way and we have to do it another. Everyone can mark their portfolio at what they could sell it for today or what they think it's worth. And one side gets to do it one gets to do the other. So that's a reasonable argument, but I still think it leads to an unreasonable conclusion. I will say 90% of my critique is about the volatility or the beta, is about saying these things are low risk. 10% is about perspective, not trailing future returns. Because if I'm right about the volatility laundering, it has implications for returns going forward. If when David Swensen was pioneering, which is what he called his book, private equity is part of an institutional endowment portfolio, he's quite clear a lot of it's an illiquidity premium, that no one wants illiquidity, that everyone's scared of it. So if you're willing to do that, you get paid extra. If I'm right that people love the fact that they don't have to look at the volatility, that means illiquidity is no longer a bug, it is now a feature. Mm-hmm. And very simple model for how expected returns are set. You get paid a higher expected return on something if you have to bear a bug nobody wants. And you pay through a lower expected return if you have a feature everyone wants and you have to pay up for it. So the chance that is going forward, I think, is quite high. Whether it means there's no edge to private equity or a negative edge or a smaller positive edge, I can't tell you that. But I do think the volatility bleeds. If you think of risk-adjusted return as numerator of return, denominator of risk, I think my statements are mostly about the denominator, but they're 10% now about the numerator going forward.
Let me run my concern about private equity, private markets by you, which is that it seems to me that like there is a ton of fee pressure in public markets, and everyone has kind of like learned the gospel of like buy low cost index funds, and even charging for Fama French factors is not a 2 and 20 business.
Yeah.
And private markets, because they're not indexable, because it's harder to like extract factors, because they're not liquid, don't have those problems, and you can charge 2 and 20 for a lot of private stuff. And so like it seems to me that there is a move to put a lot of stuff that would have previously been public into private markets, and to say we can put privates into 401ks. And there's like good economic rationales for putting private assets into 401ks because you don't need liquidity. But there's also like this like really overwhelming fee
there's
rationale.
a positive illiquidity premium.
Yeah, right. Well, that too, right. You know, you've written for years about like criticizing people for charging alpha fees for beta.
Yeah.
And it seems to me that like the reprivatization of the market is a way to sneak some alpha fees onto beta.
I think a tremendous amount of the private world is charging massive alpha fees for beta. I won't mince words about that. If they outperform or underperform on net after all these massive fees, and if performance going forward is tougher, and by the way, your point about the fee compression in the public world only makes my hypothesis that they won't beat the public world by the same amount going forward stronger.
Right.
I think privates have a big function in the world. I don't think they're going away. What you started out with me, what do you guys do for the world? There are things that are in between what should be public and what's mom and pop. But I think where we are now, I think a lot of institutions are giving up some amount of expected return for the ease of reducing their agency problem of sticking with something. Now, if they're going to be terrible and not stick with things, it might be rational to give up some return. But you can't double count and say we're making ourselves better investors by giving up some expected return, and our expected returns are going to be higher. You have to, if that's the rationale, then you've accepted my argument, and I think you have to say this is what we get paid for by making your life easier.
I am curious what you make of the push to put privates into more retail accessible wrappers. I'm talking about ETFs, but I guess I'm also talking about interval funds a little bit. It just seems like that's where the world is headed.
I'm going to hedge this and say it very carefully. I think it's a terrible idea.
Okay, go on.
There are things that end up in retail in a very good way eventually. We've done some of this when we introduced mutual funds. I can't say always going to retail is a bad thing. You can price it reasonably. You can say these are strategies you've never had before. This feels a little bit more like we've exhausted the institutions. I think I saw a number saying endowments are like 43%. It's for a number I can't verify. That's wildly specific, but that's the number I remember. So it has a feel of who else are we going to get to own this stuff?
It seems so explicitly that. It's really wild.
I think it's explicitly that. It's one of these things that for the cynics, I don't think there'll ever be a satisfying moment where we get to say we were right. It'll just be somewhat worse over the next decade. It's not one of these things like a tech bubble in 99, 2000 that, at least I don't think. There are scenarios where things get worse rapidly in secondary sales. We got close to some of that in the GFC. I was on some investment committees where we didn't do it, but we were talking about whether we would have to do that. So I'm not saying there's no chance of ugliness, but I think the meat of the probability is it's just somewhat worse. But when it does cause me some worry, sadness to say, yeah, what we really need is to stick liquids in 401ks.
Yeah.
Bluntly, I think it's a bad idea.
Well, I just wanted to talk about, and I don't know if this goes too far, but it feels like you had a change of heart when it comes to machine learning and AI in general. This is something we've spoken about before.
I did.
Well, was that like a light bulb moment, or was that just, maybe people on your team wearing you down over time?
It was more the latter.
Yeah.
The latter is the second one, right? I got to think that through every time. I tell people this. I've said it in a lot of public arenas. I tell it to clients. I think I probably slowed us down by a couple years in machine learning. I think it probably cost us some money because the stuff has worked pretty well. We've always described ourselves, and we were getting into this a little bit earlier, as a blend of data. Back tests are nice. Out of sample, long periods are even nicer. But also theory. Theory can be a formal economic theory, but it can also just mean a common sense story where you think you understand why you're making money. And there's no way to say exactly what percentage of both, but I've often described it as an attempt to be 50-50. We want something to make sense to us as economists and have strong data. when you move into the machine learning world, I don't think you have to abandon theory, and this is something I think we do a little different than most. I think there's some in the machine learning world to kind of throw theory out the window. We're still using common sense and theory to kind of limit the scope, but you are leaning more on the data. And again, I'm making up these numbers, but if regular stuff is 50-50, machine learning 75-25 data, even for us. And that was uncomfortable for me. When you've been telling a story for 25 years and it's worked for you and your clients, it's not easy to move. I also think it's not improper for the old man of the firm to go, let's just slow down. You guys come in here, I picture doing this with a southern drawl, and with your newfangled machine learning.
Twirling your mustache, yeah.
No, that's the villainous rule.
Oh, no, I think it's kind of cool, but go on.
Okay.
Yeah.
So I actually can defend it as entirely appropriate. But yeah, I had to be convinced.
Yeah.
It wasn't a light bulb moment. It was people like Brian Kelly, Andrea Frazzini, Laura Serbin, all partners of mine, presenting great results that made increasing. And I did a lot more reading. I programmed in a programming language called Lisp in the 1980s. That was an early machine learning or AI language, not even machine learning. And then I didn't do anything about that for the next 30 years.
Yeah.
So I think part of it was just me getting up to speed, frankly.
Yeah.
The thing I found compelling in the Kelly paper is like you feed like a sort of toy set of factors into like a 10,000 neuron model. And what he argues is basically you might get a better view of the actual like function that generates the results than if you just try to like use your economic intuition on a linear regression, right? It's like there's like theory behind it, and the theory is like things are not as linear as, traditional methods would
And
make it.
it's basically saying it's still a sin to only look for patterns. You still need some economics, but machine learning is better at balancing those trade-offs. So the idea of throwing more at it, when you have a better technique for that, you lean in that direction. I did have a better title, I think, than him. I wanted him. It's not better. His title's great.
Title did it pretty well.
No, but I wanted to call it simply Occam was wrong.
Okay.
All right. Maybe not better.
I think it is.
But I still want him to use that for maybe a follow-up paper.
All right, Cliff, thanks for coming.
Oh, this was fun.
Thanks for being on video with us.
Yeah, thanks for being on our first video.